do Bitcoin, the GDP miss for the December quarter, and the recent market wobbles all mean? All that and much, much more on this episode of Cocktail Investing.
All right. It is once again time for Cocktail Investing, where we look to distill the noise around us into clear investing signals.
I'm Lenore Hawkins, Chief Macro Strategist, and joining me as usual is Chris Versace, Chief Investment Officer.
Hey, thanks everyone for spending some time in your busy week with us. And believe you me, as Lenore and I know, it is a busy one. We've got more than 470 companies reporting earnings, and a number of them are high-profile ones. Everything from Amazon, Apple, Google, Facebook, and so many more.
We've got the start of the month's economic data, and tonight, on Tuesday, we have the President's State of the Union address, where he's expected to take quite the victory lap of sorts, as well as share the somewhere between $1.5 and $1.7 billion framework for rebuilding the U.S.'s extremely, extremely poor condition infrastructure. All of this is happening as the stock market's been getting a little wobbly over the last few days.
You know, Lenore, you're absolutely right on that about the stock market. It is kind of funny to hear some of the talking heads on TV and cable TV talk about it. I mean, we've been talking about the huge melt up in the market over the last several weeks, making already stretched valuations even more so. And I think it's put them, as you've written, and correctly so, in the weekly wrap and some other areas, into rarefied air that's left the market, priced almost to perfection. And you and I both know that means that when the market is priced to perfection, hitting expectations, however lofty they might be, mean everything. And if investors are left wanting in one form or another, it means we're going to see the market kind of get in the mood like we're seeing now. But here's the thing. A lot of those talking heads are, saying, is this the start of a bear market? And
you got to love that. Like, we have 2 days. Wait a minute. I mean, the market is completely losing it right now, which cracks me up. It's like, oh my God, it didn't go up. Armageddon is here. Raining cats and dogs. Like, that shows you right there. That shows you how insane the market's become.
You just stole my usual Ghostbuster line there. Cats and dogs living together. Yeah. Okay. All right.
Cats and dogs living together.
Things must be crazy if you're quoting me. So, but you're right though. I mean, the market is down, somewhere between, 2-3%. Not exactly the biggest thing in the world, particularly given the fact that we've had the strongest start of the year, I want to say ever.
But it does. Oh no, it is. It's the strongest. The last time we've seen anything like this was back in 1955. So it's been quite the record. But it really tells you that everyone is sort of instinctually aware that this is a little bit of lunacy, when just a little pullback. I mean, this is the kind of thing that in a normal market, oh, look, we're down 1%, would not be causing panic.
Right. But,
that tells you how rarefied the air is.
Right. Oh, absolutely true. And I'll give you an example. So McDonald's, MCD, reported today, Big Mac, Golden Arches, and any other, moniker you want to slap onto that stuff. Best same-store sales in 6 years. And yet...
shares went down, which is exactly what you and I have been talking about, that this market, even if you do a great job, this market is not priced for a great job. This market is priced for knock it out of the freaking ballpark over the next 5 years.
Oh no, you're absolutely right.
Just, Apple better sell twice as many X phones as expected.
Yeah, that math is not going to hold up, as we're hearing. But
no.
Yeah, it was that Morgan Freeman movie, Stand and Deliver. That's what has to happen. But the other data point too that just kind of reminds us that the market is as it goes parabolic. Reports from Charlie Schwab, TD Ameritrade, E-Trade are all talking about the surge of inflows to accounts and new account openings over the last 3-4 months. You know as well as I do that unfortunately the herd tends to come in right at the last minute and get burned.
Yep.
So just another confirming
I believe that's
data.
Rob Farrell's rule. I want to say number 5.
I think it's number 4.
Number 4, the vast majority of investors, like the bulk of investors, always come in right at the peak, and they come rushing in that absolute fear of missing out.
Yeah, well, we're going to have more on that in a little bit. But first, just a couple housekeeping items. Once again, want to thank Doug Yellens from the New York Stock Exchange and Jamie Wise of Periscope Capital and the brains behind the AI-powered Buzz ETF for joining us last week when we were down at Inside ETF. If you missed that podcast, you can find it on iTunes. You can also go, surprise, to tematicaresearch.com and check it out along with all our other wares. The great weekly wrap that Lenore puts out on Fridays, the Monday morning kickoff that we put out on Mondays written by myself, as well as all sorts of other thematic signals. And of course, there are premium products there. But, Lenore, as I think about Inside ETF, when we were talking with those guys, that was a jam-packed conference. And as I joked, not really joked, but, admitted to, I guess, last week, my dogs were barking after that conference, man. My feet were hurting with all that walking. But aside from, my maybe needing to see a podiatrist.
Aside from the orthopedic issues.
Yeah.
There were a few other things that really got our attention.
Right, exactly.
Aside from the desperate need for foot rubs.
Dave.
I think we were really surprised at the number of sessions that were on blockchain, Bitcoin, cryptocurrencies. But it really speaks to that. When you think about ETFs, don't ever forget that these are products that people need to sell. And there's a ton of attention around the crypto blockchain world. It's hitting a lot of headlines. People aren't really sure what's going on, but they're hearing like this is something very exciting. So of course there was a lot of talk on it, but I found that kind of interesting because right now it's really complicated. There's currently, there's no real way to invest directly in blockchain. You can think of blockchain somewhat. I was trying to explain this the other day. Like, how do you think of blockchain? And it's kind of like the TCP/IP protocol for the internet.
I saw some back and forth on this on Twitter today.
Yeah, there was. God, what is it? It is kind of funny, the Twitter industry. If you mention anything on Twitter, there's always going to be people who come in and just want to slam you for like, I'm more of an expert because God, that's Twitter.
Did you just say the Twitter industry?
Twitter, well, the Twitter world. Yeah,
the Twitterverse.
The Twitterverse that like, no matter, and particularly if you're dealing with like something kind of as novel and unique as crypto, blockchain, and so on, that you mention anything that's like, no, you don't have that quite right. I'm more of an expert. It's like, oh, that's not really where I was trying to go with that. Anyways, the challenge with the whole blockchain crypto is you can buy Bitcoin, which is a cryptocurrency. You can buy these other that are initial coin offerings. So there are other cryptocurrencies. You can buy those, but it's not even quite, you're not getting equity in the company. What you're basically, the crypto coins, the best way to think about that is you're going to an amusement park, and at the entrance to the amusement park, you buy a bunch of those little coupons, little tickets. And then once you get inside the amusement park, you pay for food and rides and games with those tickets, right? So that's what an ICO is. You can only use those within certain parks.
Yeah, I mean, to me, it's kind of like airline miles. You can redeem them. There is some implied value set by somebody else. And we're seeing greater uses for airline miles, or it's almost like American Express points where, at one
Except
point.
for these are fungible, like the American Express points and airline miles. I can't sell you my airline miles, but we can exchange tickets within the park, right? If we're in the park and you have tickets from another park and I want to go to that park, then we can swap tickets.
Yeah. The only reason I bring out those two, airline miles and American Express points, is because you can use them on a growing number of things to buy, to sell, to transact. So that's all. Right now there's like 1,300 different cryptocurrencies. They're all going to survive.
All right. But this is the same thing we saw like with the internet, but where we are with this that I think is interesting versus the evolution of the internet is very few people were actually aware of it, the battle pre the TCP/IP protocol being chosen. Like we didn't really know. We just when most people became aware of it, it was you already had the TCP/IP. You would go and you type HTTP:// like we already knew. We were at that point. Well, right now we're before that when it comes to the blockchain cryptocurrency world. And all these ETFs are really interesting because an ETF is not allowed to buy Bitcoin or any of the cryptocurrencies. all they can do in an ETF, all it can do really is buy a publicly traded company. So, for example, the ETF block, it's come out trying to help investors get involved in this. And what it's doing is buying shares of publicly traded companies that it thinks will participate and benefit from what's happening there. But it's not direct.
And that's in blockchain more so than Bitcoin, correct?
Correct. Yeah. Well, I think for the most part, when people are buying Bitcoin, unless you're just doing it for the hype, most people who are buying Bitcoin are doing it because it's the closest proxy available for choosing the blockchain, kind of being able to invest in that TCP/IP.
So it would be companies like an SAP or something like that.
Yeah.
Okay.
Or even chip manufacturers.
Right. Absolutely. So, it's interesting. You mentioned people buying into the hype, and there's a report out that apparently 1 million people have joined the wait list for Robinhood crypto in 4 days. And I didn't hear of Robinhood, but apparently it's a no-fee stock trading app that'll be rolling out commission-free trading in digital currencies like Bitcoin, Ethereum, starting in February. 1 million people in 4 days. Not only does that sound pretty hypey, but hang on to your hat and just listen to this. Apparently, the total influx of Bitcoin purchases, according to LendEDU, have been funded 18%, to the tune of 18% by credit cards.
Yeah.
Now, let's think about that and something that you and I talk about, which is the rise in consumer debt loads, right, and credit card debt.
Well, this is basically buying. I mean, this is akin to buying on margin in your in your Schwab account or your Fidelity account. This is a margin purchase.
Absolutely true.
Which means your losses can be way bigger than 100%.
Yeah, and that's where I'm going with this, because in reading up on this data point from LendEDU, it said that 22% of all those credit card purchases didn't pay the buy off, and 90% don't expect to pay it off until they get any kind of profit. So you do the simple math, that says roughly 20% of all those credit card Bitcoin purchases have no intention of paying the money back until they actually make some money. And by the way, what's happened with Bitcoin over the last month?
Well, it dropped from it's now seems to have found a pretty solid floor around 11,000, but it had peaked up over 19.
Yeah. So so if you go back into
if you bought November, it in December, if you bought it in December, right now you're just sweating, and you bought it on a credit card, you're sweating.
Yeah, absolutely.
But I think that's also a symptom of where we are right now, kind of in the cycle, where towards that end of the cycle, you do get all asset prices are kind of skyrocketing. And this is just one more of those. I guarantee you wouldn't see this, no matter how revolutionary this is, no matter how impressed people are, you would not see this kind of behavior happening in, let's say, mid 2009. Regardless.
Yeah, no, I think you're right.
Such a different attitude.
I'm just looking at that data point on Bitcoin and credit card purchases and thinking, man, if that percentage is underwater, that's going to be a long time to pay that debt off.
Yeah. So on at the Inside ETF conferences, as well as seeing surprising amount of discussions on something that you really struggle to be able to use an ETF to invest in, that just shows you how big of a topic this has become. We're also seeing a lot of focus on bringing 2.0 and 3.0 versions to the market, which is interesting.
Hang on. We were there. We know what 2.0, 3.0 is, but the person we're talking to. All right.
So the 2.0 and 3.0 versions is really about emphasizing new products that are fresh, not kind of that standard sector specific kind of view of it, something that has more of an interesting narrative that's not just, hey, telecom is going to do well or utilities are going to do well. Something that's a little bit more, which we found really interesting because that's our focus all along, is much more of a thematic approach.
Absolutely. And there was also a lot more talk about actively managed ETFs. The vast majority are passive and tied to an index. And as part of that active strategy, there's a lot more talk about long, short, and other alternative strategies coming out in the form of ETFs, which I think could actually, if it happens, particularly long, short, could be kind of disruptive to the hedge fund industry.
Mm-hmm. Absolutely. Well, we're seeing that the fees in those industries is struggling a bit as it
Oh,
is.
that's true. Yeah. Well, absolutely true. But I don't think they can compete with 65 bips.
Yeah, that's true.
Anyway, but as you pointed out, Lenore, let's remember that these are products that they are created, they have to be differentiated, and that means they have to be marketed. So always be wary of, fees, promises, and do your homework is the bottom line.
Yeah, absolutely. These are products. They have to be marketed. You cannot take what you read as the gospel. Look, if you're interested in ETF, look for other ETFs that have very similar holdings and compare the fees.
Well, I also think
at the end of the day, that can really matter.
Yeah, I also think too that don't necessarily fall for the tagline or the headline, if you will, associated with an ETF. Roll up your sleeves, get under the hood, and see what this thing is really investing.
Yeah, look at the holdings, not read what it says it does, but double check that those holdings make sense.
Yep. All right, so let's move on. And, Lenore, I have to say you did a great piece last week at tematicaresearch.com where you were kind of calling out a lot of issues with the 4Q GDP print that came in around 2.6%, not really what people were looking for. I think the whisper was kind of 3% or better, but again, 2.6%. Walk us through it.
Well, I did find it sort of funny here. Once again, the different Fed regions were really optimistic. The Atlanta Fed was expecting 3.4. The New York Fed was expecting 3.9, and we got 2.6. Now, that's still, the headline number doesn't sound so bad. I mean, it's below the plus 3% that people were expecting, but it doesn't sound that bad. If you look for all of 2017, we were about 2.3%. And that's kind of in line with what we've been seeing for much of this business cycle. So it's not like we really saw in 2017 a really big acceleration, despite all of the headlines trying to say, oh, the economy's on much better footing and it's really accelerating. The thing that I found really interesting is digging into the details. This number was really all about consumer spending.
Now that's a hot topic for you and I.
Yes, it was really driven. If you took the consumer spending out of it, the growth from Q3 to Q4, if you took the increase in consumer spending out, we would have less than 1% GDP growth. That's a very different picture. Now, why are we concerned about seeing that consumer spending? It's because the savings rate has dropped to a 10-year low. Now, when the savings rate drops that low, that speaks to future consumption and it speaks to future economic growth because there's just that little left to spend. Now, right now, the savings amount of savings that we're seeing being the increase quarter after quarter is now at levels we haven't seen since December of 2007. And that was, as we all remember, that was right before the economy slipped into a recession. If we look at the savings rate, that's the percent, what percentage that people are saving. That's the lowest since September of 2005. So that's, we're really seeing a big drop. Savings is now the lowest share of disposable income since the mid 2000s and is actually near all-time record lows. So we're seeing as a percent of disposable income, the amount of money that people are, stocking away is near all-time record lows. Now that tells us that in the future, there's just less to spend, right? Because they're not going to be earning on that. That savings isn't going to be putting into investments.
So I want to ask you two questions on this, and I'm going to take two opposite sides. Okay. So the first one is, we look at the data, we talked earlier about credit card debt. We've talked in the past about student debt. There's a report that you were telling me about at one point, I think on the podcast, that showed that non-supervisory wages year over year in December were essentially flat. So we see all that. We know debt's going up. It means interest expense is higher. Is it any surprise to you that we're seeing a fall off in the savings rate?
Because how else you can afford stuff, right? Like if for the roughly 80% of the population that it falls into the category of production and non-supervisory, their year over year real wage gains was 0.7%. So
nothing,
right?
Nothing.
Yet spending has gone up dramatically, right? So where's that spending coming from? Well, they're not saving for sure, and they're having to increase their debt, which is what we've seen as well. It's one of those things that I caution people when you read numbers about income levels to look into the details of how that's broken out, because when you get an aggregate number like aggregate income or aggregate savings, and it speaks for all households, that's including billionaires, the millionaires, that's including a very small percentage of the population that has extremely high income levels, an ability to save an insane amount of money. And that skews what it looks like for the rest of society, because as we've seen, right, and it's one of our themes, that you're getting that disappearing middle class. So you're getting, the rich are richer, the middle class is kind of disappearing, and those at the lower income levels continue to struggle. So when you've got that big of a spread, averaging things really distorts the data that you're looking for.
So what I'm hearing from you in that is two things. One, know the data, make sure you understand exactly where it's collected and what it's representing. But I'm also hearing too that for people that were paying attention to the data like we were, this fall off in savings, the savings rate is not exactly unexpected.
No, this is what there was the only way to do it, right? If you're going to spend more, the only way to spend more is to earn more or borrow more. Now, if you're borrowing more, you're sure as hell not saving more, right? And we haven't seen incomes going up. So there you go. How else is income? This is when we really worry. When we hear people saying, oh, growth's great, people are spending, that's fantastic. We're like, well, no, we don't want to see people spending. Like, I like it. I mean, that's good. It's good for the economy, but it's only good for the economy if they're not doing it by borrowing.
Right. So now let me take the other side. Okay. So yeah, the savings rate is low, but holiday shopping was fantastic. Companies are going to have lower tax rates. They're paying bonuses. We're seeing wages get better. Even the minimum wage is up in something like 18 states. So yeah, maybe this data doesn't matter as much.
Well, what does it yes, we've got the tax cut. We'll see how much that actually impacts, when the real problem is that people have racked those credit card bills up. They're not really seeing the vast majority of Americans are not seeing that kind of income coming in. Are they really going to be able to keep up that spending? And if what we're talking about is the stock market, the problem is the stock market is priced for people going hog wild, running into the stores and racking it up at the cash register. It's priced with the expectation that that's what's going to happen. And when we look at the reality of the vast majority of Americans, this tax cut just isn't going to give them the fuel to be able to continue to accelerating spend more.
Especially when I won't say they're peaking out, but they're likely approaching the peak level of credit card debt that they can sustain.
Right. When you see savings rate bottoming out, that's right around when spending kind of rolls over.
Totally agree. All right. Now talk to me about some of these headlines that we're seeing that talk about praising the strength of the economy.
Yeah.
So
I love these things. I love these. It's like, it's the economy. It's funny. Like, somebody starts saying it, then everybody starts saying it because it's a thing to say, right? The economy's doing great. Okay. Riddle me this. If the economy's doing so great, how is it that 16 of the last 18 data releases have come in below expectations?
Am I supposed to answer that? Keep going.
U.S. economic growth, right? Because we keep hearing about the U.S. economy, it's doing great. And we had Trump in Davos telling everyone, like, the U.S., we're doing fantastic, basically doing a you're welcome, right? Because the U.S. is doing so fantastic. Well, I'll point out that the growth in the U.S. was actually the 10th strongest out of the top 29 economies. So really, I mean, it's good, but it's not knocking it out of the darn ballpark. And then on top of that, if we're looking forward, both Morgan Stanley and Goldman Sachs put together these financial indexes that measure basically it's kind of the financial conditions, and they're measuring like how good, how easy are the financial conditions, right? And if you have really good, easy financial conditions, that means it's easy to borrow money, right? It's pretty loose. It's not so tough. When they say that they're really tight, then it's the economy, it's harder for the economy to grow. Well, both of them are at multi-decade lows. And that means that we have the easiest financial conditions in decades. So get this, with the easiest financial conditions in decades. So that means there's so much kindling around, right? To really get that economic fire going, we can't even get 3% GDP.
So
how we got the 2.6 was consumers racking up credit card debt.
So it kind of begs the question, though, with such easy money, why aren't companies taking advantage of that, right? And turning around and investing. And I think one of the reasons we can point to that is when we look at the monthly industrial production and capacity utilization reports, we both know this, that there is too much excess capacity in the market.
And that really comes down to just a few things. One, the growth of an economy is dependent on the growth of the labor force and improvements in productivity. Our labor force is growing at less than 1% a year, roughly around like half to 1%, depending on the year. So labor force is growing much, and we're used to having it grow at like 3%. You don't really it's much harder to get productivity gains when you're already a very developed nation, and we don't yet have that next, maybe blockchain will be it, but we don't yet have that next massive leap in technology that allows for an incredible jump in productivity. So our potential growth is just slower. And then on top of that, you have a mountain of debt all over the world. And that debt acts like a really big, heavy backpack on the economy.
It's an interesting visual. So I'm
climb up that hill.
Right. So I'm listening to you there, and I'm thinking, last week at Davos, Trump essentially communicated a message of America is open for business. Mm-hmm. We want to do fair trade and all this other stuff. And in the back of my mind, as you were talking, I'm thinking, I'm wondering if he's positioning this to draw more companies into the U.S. to create more jobs, but also to take up that slack in the economy that we're seeing. So there might actually be a higher capacity utilization level, forcing companies to eventually invest and build out PPE and other things.
Well, I believe that was also part of, we shouldn't have actually said it out loud, but Mnuchin's comments on a weaker dollar is good for the U.S. Mm-hmm. Because part of Trump's, his voter base are people who are involved in creating those products that we sell outside the country, right? So that manufacturing base. So, and that's true. A weaker dollar is great for our exports, a little bit tough on those of us in the US that are buying products that are made outside of the US. They become a lot more expensive.
Mm-hmm. Kind of funny how fast they walk those comments back on the dollar.
Yeah, but you gotta love though when it comes out and the dollar's like, what? Because I mean, when you have like the Treasury Secretary saying a weak dollar is good for the U.S., everybody ought to pay attention, right? So the dollar goes whoomp, the DXY is like drops right down. Right, the next day, then Trump's like, no, we don't mean that, and the dollar index kind of went, yeah, I'm not buying it. It sort of popped up a little bit.
Well, right. I mean,
and then the next day, right back down again.
It was almost like, Mnuchin was kind of saying, in general, in a hypothetical sense, a weaker dollar is better for us, which is absolutely true. But we know
it's better for exports. But
yes.
But we have a trade deficit, so we import more than we export. Now that's can be addressed a bit by the lower dollar, right? Because the weaker the dollar, the cheaper our products are for everybody else. So theoretically, they increase the demand because our products get cheaper, and the more expensive stuff gets for us to buy. So the demand for imports goes lower. Okay, there's the math, but it just makes that TV you're buying down at Costco a hell of a lot more expensive because you're importing it from South Korea.
True, and the last time I checked, there are no U.S. TV manufacturers.
Right? I mean, that Samsung got more pricey.
Yeah. All right. So let's dial back to some of these headlines that you were talking about, these overly bullish ones. And let me just kind of say, all right, so we are seeing a downtick in the SESI index. I know that's one of your favorites. And we're seeing growth pick up outside the US, Europe, and elsewhere. But when we look at some of the data out there, like freight tonnage, and I know that you and I like that, because the idea is that stuff is getting moved, whether it's into production or getting to distribution centers, to stores to be sold. Freight tonnage is picking up. There's a shortage in truck drivers, and we're actually seeing rising spot market rate prices for tonnage and freight. So
all that stuff people put on the credit cards has to get shipped around somehow.
Yes, absolutely true. But then we're hearing companies from Constellation Brands, Campbell Soup, J.M. Smucker, and others saying that these higher costs are going to hit them on the margin.
Yes, but tax cuts.
And we have to remember that tonnage tends to pick up in April when we start to see the produce, i.e. vegetable season, come in. So I'm just sitting there and I'm thinking,
let's not forget oil. The oil prices have been on a tear, which also increase freight costs.
Absolutely true. But this one thing on the availability of trucks seems to me that perhaps the economy might be on certain areas humming along a little better than some of the
Oh,
headlines
it's
might
not.
say.
I mean, we're not by no means. It's not like we're heading into a recession in the next, couple of months.
So hang on. So I was watching a cable channel that we've both been on this morning, and somebody said, and I caught this earlier, that we're not, are we seeing a not a pullback, but are we seeing a correction in the market? And a guest said, no, we're not. There's no signs of a recession around at all. That's usually when we tend to see these corrections like that.
Sure.
So the point
A
being,
big one. Usually
right,
don't get like a 20% pullback without a recession.
right. So just to kind of pull this up, it sounds to me like, yeah, there's a lot of mixed numbers on the economy. Maybe some areas are perking up, but by and large, it looks like it's going to continue to hum along at least for a little while longer.
Yeah, in that roughly 2% a year, well below historical norms, but not terrible, not falling off a cliff. The real issue is you have a stock market that is priced for knocking it out of the darn ballpark when we don't see data to back that up. And you have a market that's already priced really richly and expecting. I mean, you saw over the past month, the increase in earnings expectations for the S&P 500 is bigger than it's unprecedented. That level of an increase in expectations is just something we've never seen before.
Well, it's going to be interesting because I know this week is, like I said, 450, 470 companies reporting. And I think coming into this week, just 23% of the S&P 500 companies reported. So what does that tell us? It means, over the next week to 2 weeks, we'll see the vast majority of those 500 companies report. And I think we'll get a much better sense as to how much of that increase that we've seen in expectations is due to tax reform and how much is actually due to, well, let's just call it business operating as it does.
Mm-hmm.
So, all right, now talk to me before we just kind of shift gears and get back to some market commentary. Talk to me as a setup, interest rates in the dollar, because it looked like the 10-year kind of broke through a level, and that caught some people off guard.
And I think that's one of the things that probably has led to what we've seen in the market this week, Monday and today, Tuesday. We've seen bond yields really start moving up. And if you look at what's been driving that, a lot of it is expectations of inflation. So we've seen bond yields really moving up. We've seen the yield curve continue to flatten, and that's never a good thing. When that yield curve flattens, what that means is the difference between short-term and long-term rates is getting narrower and narrower. That's a flattening yield curve. And what that means is that you're not incentivized to lend longer term. So it makes it tougher to invest in long-term projects, because if you're going to get say 1.5% to lend for a couple of years, why would you get 1.6? Why would you get just a little, not much more to lend for a longer term?
But I'm hearing, again, I apologize for cutting you off. I'm hearing you say this, and I know that tonight we've got the State of the Union address, and Trump is going to be talking 1.5, 1.7 spending. But if lower rates are falling, which is, I think, what you just said.
Right? No. Lower rates, I don't know what you mean by lower rates. We've got short-term rates are going up. Long-term rates have started to move up as well, but the difference between the short-term and the long-term rates has been shrinking.
Okay.
Because short-term rates are moving up faster than the long-term rates are. And we've also seen that the corporate bond spread is down to the lowest level seen since 2007. And what that means, the corporate bond spread is the difference in yield between those super AAA, fantastic, the great companies that you've got really, really low risk. The difference between what those are, which you would think that'd be lower, right? Because it's less risky. And the yields on super risky corporate bonds, the difference between those is the lowest we've seen since 2007.
So let me ask you this. What do you think is the appetite for bonds out there?
Well, that's a big are we talking treasuries, European sovereign, corporate?
All right. So let me get a little more specific then, because this will tie into the question that I was thinking I was going to ask. So, you're talking about all of this, and the reason I asked the bond question is it's becoming increasingly apparent that Trump's infrastructure plan is going to hinge on a combination of federal money, right? Maybe up to the tune of just 20% for projects, and the balance has to come from someplace else. So the someplace else, it sounds like it could either be public-private partnerships, we've seen those, or it could be from the states themselves. So if they have to fund up to 80% of a potential project, that means there's going to be a potential flood of municipal bond debt out there.
And let's not forget that we last year had one of the biggest deficits we've had in the past 4 years. And we're going to even potentially most likely have an even bigger deficit this year because those tax cuts were not matched by any kind of spending cuts. And given just the state of the economy, and this is not saying anything negative about tax cuts, love tax cuts, but given where we are in the business cycle, if you're deep in a recession and you have tax cuts, that has a bigger impact. If all things else being equal, tax cuts in the depths of a recession are going to have a bigger impact on the economy over the next, say, 3-4 years than tax cuts at the very, like towards the end of the business cycle, when you've been in a recovery mode for, let's say 10 years. But at that point, the economy has been going along for quite a while. You don't have all this pent up demand. It's just going to have less of an impact. That's just a reality. So these tax cuts, how much they jack up the economy, we're not, debatable if it's going to have a whole hell of a lot of an impact. And that is only because of where we are in the business cycle. So really, are you going to get that economy going? And now we've got these deficits, and the deficits are growing, so that means there's more treasury debt, right? More US bonds are going to be floated. We're going to do this infrastructure thing. Okay, well, the infrastructure means that the states are going to have to float more bonds. Okay, right. On top of that, the Fed is trying to shrink its balance sheet. The Fed is not scooping up all of those bonds that it used to. So that's a big buyer of bonds has been stepping out of the market. So, what does that mean? More supply. And we're asking for there to be more demand, right?
Exactly.
Now, okay, let's say that there is more demand. All right, more demand. Well, where did that demand come from? They're not buying stocks, because now they're buying bonds, right? Now, I'm not saying that that's going to happen, but if it were, like, who's going to buy those bonds? There's just more stuff to buy, right? When there's more stuff to buy and you haven't really changed the number of buyers, because how the hell do you suddenly, bring aliens in? It's going to affect the prices, right?
So no. You can't bring any aliens in because of the wall that's going up.
Oh, right. Sorry. Well, it'll be interesting to hear from Yellen this week, because this is her last policy meeting at the Fed. Her goodbye serenade. And by the way, when we're talking about all these yields, it's not just here that we're seeing those bond yields rising. We're also seeing in Germany, everywhere from like Germany to Switzerland to even South Korea. All of them are hitting these multi-year highs on the 10-year. And just to really emphasize the point with what's going on with imports and exports, so far in just January alone, the dollar has dropped 3.4% against its major trading partners. That's a really big move for the world's global reserve currency, which is supposed to be super, super stable.
I just shaking my head.
Yes, he is. He's actually shaking his head.
It's going to be really something. Well, it will be interesting to see what Yellen has to say. There is growing speculation that if the data does come in better than expected, the Fed might boost not 3 times but 4 times this year. That pricing, the pricing in the market for that has been going up. It wasn't like the pricing was putting it like 0 probability, and now it's moving up to like, last I looked, it was like over 25%. Yes. So we'll see. I mean, it's very early in the year, and we'll see.
And these are headwinds to stock prices too, because part of stock price is the earnings, and those earnings are dependent on servicing debt and maybe going out and borrowing more. And if interest rates are going up, that means that they're paying more and servicing that debt, and that just means lower EPS.
Lower EPS. It also means potentially less money to continue to buy stocks, or
fewer buybacks.
Or fewer buybacks, or maybe I can't buy as much Bitcoin as I was hoping. Anyway, but it's just, again, fascinating. Earlier in the program, we talked about comments from TD Ameritrade, Schwab, E-Trade about an acceleration in new account openings. And then kind of backing that up, the Wall Street Journal reported earlier this week that global equity stock mutual funds and ETFs pulled in the most ever in the past 4 weeks. And if I have the math right, the records date all the way back to 2002. So think about that.
16 years, the most in the past like 16 years. That's meaningful.
Yeah.
There's also in the journal on Monday, I love this, coming out of from Howard Marks of Oak Tree Capital Management, who is arguably, he's up there in the list of greats investors of all time.
Sure.
He said that most valuation parameters are either the richest ever or among the highest in history. In the past, a level like these were followed by downturns. Thus, a decision to invest today has to rely on the belief that it's different this time. I'm convinced that the easy money has been made. So we're not alone in thinking that, things are a little pricey right now.
I'm sorry. That last part. I'm convinced the easy money has been made.
Yeah.
Really?
Yeah. Well.
But yeah, I mean, look, there's no doubt about it. And I just get a little more concerned about, again, it's a classic sign, more and more people piling in right at the tail end. And it's just,
the Investment Company Institute recently revealed some data that shows that liquidity ratios in funds are at all-time lows. So again, we're back to that low cash balance.
I was just going to say, when you say liquidity ratios, you're talking about cash on hand. Yeah. And it's amazing to me, and we see this from time to time, that, and it's not just individuals, but it's institutional investors too, that they almost know the market's going higher, but there's that, that FOMO that they deal with, fear of missing out. They almost have to hold their nose and buy, to use the expression, as stocks continue to get more expensive because they can't afford to be underinvested. It's kind of a silly game, I think. So.
Well, and it's also when the M&A boom, you usually get that towards the end of the business cycle, because as you get towards that end of the business cycle, it's harder and harder to generate organic growth. So if you want to grow that EPS, you have to buy the EPS growth.
Right. And I think it's a combination of two things. I think one is that organic growth, but I also too, just given our thematic bent, we know that there are a lot of companies out there that are not in the tailwind of some of our themes, and others are hitting these headwinds.
So it's strategic as well.
Right. I think they're trying to pivot their businesses, and we have seen a lot of that. Even over the last couple of days, Dr. Pepper is getting scooped up with Green Mountain. That's obviously trying to reposition themselves out of our fattening of the population with sugary beverages into something else. Not quite sure the new company will really ride the food with integrity wave. SAP is buying Calia software for $2.4 billion to get even deeper into the cloud. Clearly, they're looking to ride our connected society and disruptive technologies themes. Ford. This is the one that really surprised me a little bit, I have to tell you. Ford acquired Autonomic, which is an urban transit service, which deals with consumers and businesses alike, and also Translock, which optimizes driver routes for transport operators. And I read that, and I said, could this be part of Ford's eventual push into autonomous cars? And
yeah, I think they see the writing on the wall. I mean, traditional car manufacturers are facing massive headwinds because their businesses are currently and it's only going to get worse, fundamentally changing.
Absolutely true. But check this out, okay? When I was reading this, it was kind of like pulling on a thread. So those two businesses are going to be folded into Ford's Mobility Business Group, which also is home to Chariot. And I was like, what is Chariot? Chariot is, and this is a direct quote, a Ford transit wagon driven by professional drivers who are background checked and fully employed by Chariot. Vehicles are locally licensed and commercially insured. And the tagline for Chariot is reinventing your commute. Hello, that sounds a lot like Uber. That sounds a lot like Lyft. And it sounds to me like Ford, to your point, understands who it will be selling its cars to in the future. And it's a direct pipeline eventually for what we'll one day call an autonomous car fleet.
Yep. There was also Kroger apparently was eyeing our buddies over at Box.com.
Well, that's true. Kroger was also eyeing Overstock. But, Shay, our buddy over at Box.com, who we had on the podcast, I guess it's almost a year ago now, he apparently was invited out to Seattle, wink, wink, nudge, nudge, to see a guy by the name of Jeff. I wonder if, probably the same guy who owns the Washington Post and, the guy who's worth more than, anybody.
God.
Jeff Bezos. So, and remember too, that you and I called it.
Bezos sitting down going, you know what, God, I think this whole angel thing, I think we can make it a little more efficient. just a delivery system we can handle a bit better.
Well, you know what? I for one hope that Boxed and Shea are taken out by Amazon, because then we can say we called it a year ago.
Yeah.
I think it's going to happen.
More of the Borg.
Right. So it's more of the board. So that's just some of what's been going on the last couple of days. Do you see, as companies repatriate more of this cash, do you see more prospects for M&A?
I think yes, but I think it's also going to be tempered by what we see happening with bond yields, because an awful lot of these are going to be funded with bond issuance. So if bond yields keep moving up the way they're moving, you can see today a lot of this, what we're seeing in the wobbly markets, is concerns over that really rapid move up in bond yields. But the market is also just really poised to kind of chill out a little bit. I mean, so far this month, we've had 14 record closes. The last time we had that happen was in June of 1955.
Now, let's remember, too, that there's only, because of the way the holidays fell this year, there's only like 19 trading days in the month.
Yeah. So it's almost a whole month. I mean, it's unbelievable. And on top of that, by today's close, well, it doesn't look, well, let's see. Yeah, we're not going to get it today. It's not going to happen. But by the end of today's close now, barring, it's Tuesday morning. it's 1:30 in the afternoon. I guess not morning for me, not you.
That's right.
Right. So we're saying this at 1:30. The market has gone 400 days without a 5% pullback. That is literally completely without precedent in the entire history of the market.
And just so we're clear, you're saying 400 days, 5% pullback. You're not saying a 5% pullback in one day.
No. I mean,
over a period of days.
Yeah, exactly. From wherever you are, that like recent high to ever pull back 5%. And on top of that, this one really blew me. Global volatility is down to 60-year lows. Yeah, that doesn't make you nervous. It's all good, though. It's fine.
All right. I was just going to say, is there anything good? And I'm sure Donald Trump will tell us exactly what's good tonight in State of the Union. He's going to take a victory lap. He's going to talk about America being opening for business. He's going to talk about people being flush with cash from tax reform, blah, blah, blah. To me, the real key on this is going to be, and we alluded to it earlier, is going to be infrastructure. I expect the framework. I do not expect specifics. You?
Well, yeah, right. Come on, that's standard. But to be fair, you don't normally ever really get that many specifics in a State of the Union address. And yeah, we'll probably get the victory lap. And just to be clear, yeah, the tax cuts, they are going to help. They are going to give people more money, so that is good. The economy not falling off the rails. Like this is we're just saying stock market has been priced for an epic economy. And we're just not there. So you always have to look at, well, where am I now and where is it expected to go? We're not saying that the stock market is, heading for a 50% pullback in the next month, right? We're just saying, watch out, good time to have protection because we're in rarefied air. So your upside, the potential for upside when you're really this highly priced versus the risk of downside, well, it's worth putting a little protection on.
I think I'm going to cap it all off by Lenore saying that in the past, we've seen that when the difference between expectations and reality collide, not exactly pretty. Doesn't mean it's a disaster. Probably more a reset of expectations.
Yeah. Well, hell, we made it through 2009. So.
Trying to go out on a high note. That's not really a high note.
Okay, the high note. How about this? The high note is look around outside of the U.S. as well. There are plenty of markets outside the U.S. that, like Europe, for example, their economy is really starting to hum along. They're a couple years behind us as far as the business cycle. Like they were really bottoming out in the recessionary conditions about 3 years roughly after us, 3-4 years. So there's some stuff, and they're not nearly as extremely priced. And Japan as well is another one where their economy is kind of turning around, and they're not as richly priced.
Let me put a bow on this and bring it full circle.
All right.
It's one of the easiest ways for the average investor to invest in markets outside the U.S. ETFs.
All
right. So with that, let's cap it there, Lenore. I will see you next week, and we'll talk a little more about what's going on. And hopefully, maybe next week, not sure yet, maybe we'll get to that second part of the fall of the middle class, because we did the rise of the middle class. Might be timely with some of the data. We'll see.
Have a great week, everyone. Thanks for joining us.